Hi, I'm a senior consultant working at Certicom Group of Chartered Accountants. Today, I'd like to take you through the nuances of tax treatment of foreign shares and also demystifying how the international investments are taxed and what it means for your overall financial planning.
Hi everyone, I'll be talking about the different types of foreign stock options. This usually occurs when an Indian resident is working in an MNC, wherein he is compensated the stock options of the parent company which is listed in the foreign country, for example USA. So this stock options is usually taxed as perquisites in salary income. So I will be briefing you about the three different types as follows. The first one is restricted stock units. These are the stock options which is granted by the employer to the employee at no cost. These usually have some vesting conditions attached to it. The vesting conditions can either be periodic based or performance based. Upon the satisfaction or accomplishment of these vesting conditions, the stock options get vested. So on the vest date, the employee gets the shares. For example, I've taken that the vesting date here is 1st of January 2025 and the fair market value of the stock is $50. So on this date, the employee will get the stocks for which he has not paid a single dollar. So when we calculate the perquisites, we just have to see how much benefit he received. So he's getting $50 worth of an asset for which he has paid zero dollars. That's how we calculate the perquisites, which is taxed as salary income. Now I'll be explaining about employee stock option plan. This has a right which is given to an employee to buy the shares at an exercise price which is predetermined on a future date. I'll explain this through an example. Here I've taken the exercise price of $30 and the fair market value of that stock is $50 on a vesting date or exercise date, let's say 1st of January 2025. So when the employee exercises his right to buy shares on 1st of January 2025, the worth of the stock is $50 for which he has paid $30. So the benefit which he is getting here is the difference between the fair market value on the exercise date minus the exercise price, which is $20, and this is taxed as perquisites under salary income. The last one is the employee stock purchase plan. In this plan, the employees will buy the shares of its company at a discount. There's usually an offering period in which the employee will contribute some amount from their salary income, which can be used to buy the shares at the end of the offering period. So, for example, I have taken that the discount is 20%. And when the employee will buy the shares, they will get a 20% discount on the price of the share on the purchase date. So let's say that the fair market value on the purchase date is $50. So when they purchase those shares, they get a 20% discount. And here the discount is taxed as perquisites. Once the stock options are vested or exercised, this becomes part of the stock holdings of the employee. On holding such stocks, the company can often declare dividend. And when the employee receives such dividend income, it is to be shown as income from other sources. One more income which could arise is when the employee is selling his stock units. On the sale of the stock units, the cost of acquisition which is to be considered is the fair market value on the exercise date or the vest date. In the example here, I have taken that the employee has sold his stock units for $80 and the fair market value was $50 on the vesting date. So the capital gain here is computed by subtracting the cost, which is the fair market value, from the sale proceeds, which is coming to $30. An important point to be noted here is that For the cost of acquisition, we do not take what the employee has paid. Under ESPP, he would have paid an amount after discount, or under ESOP, he would have paid an amount which is a predetermined amount which is less than the fair market value. So we don't take that amount. We have to take the amount which is the fair market value, because on the fair market value he has paid the perquisites already, which is taxed, as I explained in the earlier slide about ESPP and ESOPs. When the assessee earns any income from a foreign country, often the foreign country will withhold certain taxes as per the local laws. As we are talking about an Indian resident, he has to report his global income earned. When reporting the global income, he will have to pay taxes here in India as well when filing the ITR. And he had already paid taxes before when he received such income. To counter this, the government has provided tax relief under two sections, Section 90 and Section 91. Section 90, it is with the countries from which the SSE has received the income, which has DTAA with India. Here DTAA is the double tax avoidance agreement. And under Section 91, those countries which does not have DTAA with India. The tax relief can be claimed by filing Form 67 before submitting your ITR. I appreciate your patient listening. Thank you very much.
Thank you for watching. Please stay informed and keep tracking the space for more insights on tax strategies and investment compliance.